ServiceNow is an absolute cash printing machine with a 98% renewal rate and pretty good quality and balance sheet health scores in my Quant rating system. Yet, after its last earnings report, the stock dropped 20% before pulling off a massive 60% rally just weeks later. So, the market is completely torn, and there are good reasons for this. Competitors are pressuring them, and the fundamental rule of how software companies are making money is breaking. We can already see this in their margin outlook that has massive headwinds. So today, I'll have a look at the financials, analyze the hidden operational shifts that are happening behind the scenes, and run a discounted cash flow analysis to see what the stock is really worth. And if you're new here, my name is Florian and I'm a physics engineer from Germany with a passion for data-driven and rational investing. Welcome to the channel and thank you for joining me today. So on April the 22nd, ServiceNow reported its earnings for the first quarter. And the immediate reaction looked like a textbook panic. Their subscription revenue and total revenue was up 22%. Their current RPOs by even 22.5%. The generative AI platform, Now Assist, was even accelerating so fast that management jacked up its full year annualized contract value from $1 billion to $1.5 billion. So by almost every mainstream retail metric, it was a flawless beat. Unfortunately, all this didn't help the stock, because it still crashed by almost 20% on the earnings day. But if you panicked and sold there, you missed what happened next. Because since then, the stock staged a 60% recovery, completely erasing the sell-off and even gaining some ground. This kind of extreme volatility doesn't usually happen to an enterprise software giant. It tells us that the market is deeply conflicted. One faction looked at the forward-looking indicators and saw a structural AI breakdown. The other faction looked at the sell-off and saw a rare buying opportunity in a premium compounder. So, which side is right? Did the algorithms overreact to short-term noise, or did the dip buyers buy a value trap? To answer that, we first have to look past the surface numbers and look at what ServiceNow is actually doing. A lot of people think of them as just another IT help desk software, and that is a massive underestimation. They could better be described as the digital landlord of the Fortune 500. ServiceNow provides business software for many departments or workflows in a big corporation, from CRM over HR to digital security. But they don't just build the software interfaces. They know and own the underlying workflows between different departments. So if one employee changes departments, ServiceNow orchestrates the entire cross-department process. IT provisions a new laptop, HR changes the payroll, and security updates the access rights. So while most major software applications own the data, ServiceNow owns the actions and the workflows. This gives them massive switching costs. Deploying this platform costs anywhere between $1 million to $8 million a year, and it takes months, sometimes even years, to fully incorporate it into a corporation's infrastructure. That creates an incredible barrier if a customer ever wants to leave. It explains why their core platform renewal rates are so high. They sit pretty steadily between 97 and 98%. My Quant rating tool spits out near perfect scores for health and profitability because of a very clean balance sheet and high margins. Their quality score is also quite high because of their high MOAT and high secure growth. But this great quality is in contrast to the value and momentum score, which sits deep in the red. The assumption amongst retail investors seems to be that because the business is so great, the stock is safe to buy at any price. And this setup is exactly what makes the hidden numbers inside the financials so unsettling. Because if you look purely at the underlying financials, the bull case isn't just compelling, it looks bulletproof. The top-line growth is very strong. We are looking at a company that scaled its revenue past $30 billion while consistently maintaining year-over-year growth rates above 20%. And when we look at the balance sheet, the picture gets even cleaner. They have negative net debt because they are sitting on a massive $3.7 billion cash pile. And the free cash flow margin has been consistently above 30% and growing for the last couple of years. This isn't a speculative tech play that is still burning money. It's a high margin compounder that is already operating at a massive scale today. But a great growth and clean balance sheet doesn't mean a thing if the market has already priced it to absolute perfection. And as rational investors, we have to ask ourselves, what growth rate does the current share price actually imply, and is it realistic? To find that out, let's run the numbers through my valuation spreadsheet. For my estimations, I use these input values which reflect the current market environment as well as the latest financials of the company. And at a market price of around $135 per share, the model shows that the market is pricing in a long-term free cash flow growth rate of just 9% right now. Think about how conservative that expectation is. ServiceNow has compounded its free cash flow at 23% historical CAGR over the last decade. And Wall Street consensus is expecting the same growth over the next 3 years. So the growth expectation at the current price is incredibly low. The market is pricing the stock as if its growth engine would slow down to half of what analysts expect the real growth to be. Just look at the sensitivity matrix. If ServiceNow simply executes on my already conservative base case assumptions, a growth of 20% and a WACC of 8.3%, the fair value jumps up to $207 per share. That represents a massive 50% upside from today's levels. Under almost every reasonable scenario on this grid, the stock looks heavily discounted. Even when we include my margin of safety of 10%, the discounted cash flow still gives us an upside of almost 40% to today's price. At first glance, this looks like a paradox. The company has a strong moat and is growing at over 20% per year. And the discounted cash flow math tells us to buy with both hands. So why on earth did the stock still drop after earnings, and why are institutions still treating it with intense caution? Well, the answer is actually pretty simple. It's because despite their moat, there are still active structural risks that could disrupt the whole business model. But before we go there, if you like this kind of objective analysis over the typical stock market hype and think that it helps your own investing, take a second and hit subscribe. I post 1 to 2 of these videos per week and spend at least a day of research, oftentimes more, for each company. But back to the company today. So the real risk with ServiceNow isn't that their growth is slowing down. The data shows the exact opposite. Their highest value tier, the accounts spending over $5 million per year, actually expanded to 630 clients last quarter. The real threat is far more subtle. Because to keep this growth alive in the age of artificial intelligence, ServiceNow is changing the way they make money. They are systematically phasing out the traditional pricing model. Up to now, they sold their products mostly with seat-based licensing. But autonomous AI agents completely break that business model. If an enterprise deploys an AI specialist that can instantly execute multiple complex workflows at the same time, that corporation doesn't need to add more employees. They can shrink it. So if ServiceNow kept charging strictly per human seat, the addressable market and with it, the revenue would also shrink. So to protect their revenue, management is executing a massive pricing pivot. They disclosed that in Q1, a staggering 50% of the net new business came entirely from non-seat-based commercial models, specifically consumption and token-based packages and digital assets. Instead of just selling access to a platform, they are charging a premium for the advanced and prime tiers, which include a certain token amount for AI capabilities. But once a company burns through that baseline, they have to buy additional token packages. Strategically, this is a brilliant hedge against headcount reduction. But from a valuation standpoint, it strips away one of the biggest reasons investors pay a premium for enterprise software: absolute revenue predictability. Such token-based billing introduces usage fluctuations from quarter to quarter. Up to now, their income and growth was very steady and predictable. But now, half of their new growth could fluctuate or even break away on a short notice if customers don't buy extra tokens. Yes, the renewal rate is high, but we just don't know how much revenue these customers will generate in the future. Another thing is that ServiceNow wants to be the absolute standard for corporate workflows. But that ambition drops them right into a two-front war against Microsoft and Salesforce. To help with the user interface, ServiceNow bought MoveWorks and turned it into EmployeeWorks. This is a smart defensive play. MoveWorks already had a footprint across millions of employees. But the problem is that Microsoft's Copilot sits on the exact same desktops. And Microsoft's playbook is simple. Bundle Copilot into existing enterprise agreements at near zero costs. ServiceNow's response in their last conference was coopetition, as they put it. Integrating the AI control tower to manage Microsoft's agents. But let's be real. If a company can get an AI chatbot for free from Microsoft, paying a premium standalone subscription for ServiceNow will be pretty hard to sell. At the same time, while Microsoft squeezes them from the top, Salesforce is undercutting them from the side. Salesforce launched Agentforce IT Service specifically to raid ServiceNow core help desk domain. They even position this directly against ServiceNow on their homepage. And Salesforce even claims deployment speeds that are 16 times faster than ServiceNow. But their real weapon is a flex agreement that lets companies swap budgets between human seats and digital agents on the fly. Now look, from what I found, Salesforce still lacks the deep IT compliance and complex workflow integration that makes ServiceNow so attractive to the Fortune 500. So the core moat isn't breaking today. But when two of the biggest and most aggressive operators in software are squeezing your interface and are beating you with flexible pricing, I still start to wonder if the moat exists in the same way in 3 to 5 years from now. We can see that pressure already in their margins. Usually software companies are supposed to get more profitable as they scale. That is the whole point of the business model. Once the platform is built, adding the next customer should cost next to nothing. But look at ServiceNow GAAP gross margin. It has dropped for the last 5 consecutive quarters, falling from 79% down to 75.1%. That is a crash of 4% in a single year. Now, the management blamed this margin depression on the recent acquisition and states that this is only temporary. But that excuse masks the core issue. Because delivering AI is simply more expensive than traditional software. It's not just a one-time cost to build anymore. Every single time a user asks the AI to automate a workflow, it triggers a variable cost that eats into ServiceNow profitability. That is also why the guidance on margins for the full year has been revised down, at least for the gross margin. Now, this might not sound too bad at first, but when a company trades at a forward PE of 31, an EV to EBITDA of 19 and price to free cash flow of 21, any structural threat to the long-term margins could hit this valuation hard. And yes, the current valuation is much lower than their 5-year averages. This might not sound too bad at first, but compare it to the peers and it is still not cheap. In terms of PE, only Oracle is more expensive. Their forward EV to EBITDA multiple is the highest of the group and the price to free cash flow is only beaten by Microsoft that currently has a distorted multiple because they put all of their cash flow into new data centers. So I wouldn't say that they are cheap per se, even though it might look like it on first glance. But there is another piece to the puzzle. While retail investors rushed back in to buy the dip, corporate insiders were doing the exact opposite. Insiders have been systematically selling their own shares. Now, people can sell shares for many reasons, so this is not a deal breaker on its own. But in this case, it's not just one person, but several. And they all seem to think that the current price is not too cheap. Otherwise, they wouldn't all sell right now. Now, last but not least, we have to look at the RPO, the remaining performance obligations. Because while the company always states a nice growth on a year-over-year basis, the last quarter specifically showed a general decline for the first time. Nothing to worry yet, especially with the recent shift in business model that could have an impact here, but a trend that I would still observe and see if it continues in the next quarters. So, where does all this leave us? On one hand, you have 5 quarters of gross margin contraction and a structural shift away from predictable seat licensing. On the other hand, we have high renewal rates and still a strong moat that makes them especially strong with the big Fortune 500 companies. When we look at the rule of 40 that sums up the revenue growth with the profitability, in this case I used the free cash flow margin for this, they also still easily beat the threshold of 40 and have the highest score from their peers, mostly because of the higher revenue growth. So the business is still pretty good. Now, I do think that the risks that I covered are real and should be monitored, but none of them are disrupting the current business in a significant way. The biggest threat that I see is the valuation. I don't think that this will go back to the values we had in the last 5 years, and with this, the stock price will also have a hard time to bounce right back up. But it doesn't need to go back the full way immediately to be a good investment, and the upside of around 40% that my discounted cash flow model gives is based on fundamentals, not the relative valuations. So all in all, I do think that the current price is a good entry price for ServiceNow. But because of the persistent margin pressure, I wouldn't go all in and keep this position a smaller and more speculative one. If you want to wait a bit to see how this plays out, the next major event is in late July when the Q2 earnings drop. If you want to track what's really happening behind the scenes, I would ignore the headline revenue numbers. Instead, I would watch 2 specific indicators. First, I would check the subscription gross margins. If that metric falls below 75%, real-time AI inference costs are eating the margins alive. And second, watch what happened to Salesforce's agent force. If ServiceNow growth decelerates while customers switch to agent force, the bull case might be under real danger. But until then, you buy a premium compounder for a very reasonable price. But as always, that's just my opinion. Now, what about you? Are you already invested in ServiceNow? And do you think that the business is in real danger from Salesforce and Microsoft? Let me know down in the comments. And if you would like to know which of the Max 7 stocks is the best investment after the last earnings season based purely on the financials, check out this video next. And as always, this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys, and see you in the next video.